Well, welcome into Making Sense. You know, most of us watching this show have been around a while. You're probably at least in your 50s because that's what we tell you. Time of your life starts at 50. But many of you are in your 70s and 80s. You grew up when you maybe bought a stock and you said, wow, this is a great domestic stock. And you just worried about how it performed in the United States of America. Well, things have changed as we get into 2015, and everything now is on a world stage. And to take us to that stage is Brandt McDonald, the principal at McDonald, Barranco, Hagen Wealth Management. And Brandt, first of all, thank you for coming. It's always a pleasure to have you here. You give us some great information because one thing, and one of the reasons we have you come on the show is you do your homework.
Well, we try. I mean,
Yes.
we certainly try. I mean, we live, breathe it, eat it, sleep it. I mean, and that's the honest to goodness truth. We are very fortunate and very blessed that we've had so many people around the country entrust their hard-earned capital to us, and we know it's a very serious business. So we try to put as much time and energy into it as possible. And you're right, though, Jack. I mean, one of the things that we have to contemplate now more than ever before is that it's not just a U.S. domestic story. I mean, certainly Washington and tax policy and regulatory environment impacts everything that happens here locally. But you really have to zoom out and start thinking about things in terms of the total global economic picture, because there are what we call in our business all of these feedback loops that are taking place. You know, so much intertwining and intricacies that are going on between financial institutions here in America and abroad. And so what we like to do is sort of go around the world and look at these markets independently and try to connect and establish where those pressure points might be. And so when you think about Pacific Rim, that's anchored by China clearly, and then obviously Japan right there with them. And when you put those two countries together, that equals the United States GDP. So clearly, Japan, they have embarked on their own QE program. They have really stepped it up. They're printing yen like it's going out of style. They're trying to monetize their debt and bail out their own pension funds. It's an incredible story and really unbelievable to sit back and watch what Japan is doing. I think they have some real issues more demographically than anything else. And then when you look at China, China has this sort of shadow banking market that's really difficult to keep a track on. Many people around the world have tried their best to look at some of these beige book type numbers or to back into what the real credit conditions are in China. But no one really knows for sure because the Chinese government essentially controls the official banking sector. But what they can't control so well is the shadow bank, and these are large institutions that are lending to one another, and not in a situation or in an environment that's not so heavily regulated. So you don't really know what's going on there. And so that's quite concerning, and even the Chinese government now here recently has begun to decrease interest rates because they see their economy, the growth rate has really plummeted, and there's some discussion and real great debate out there as to just how fast China really is growing, because this is still a communist country. And so you just can't, it's tough to get a handle on sometimes. But so when you combine those two big countries that are equal to the U.S. in GDP, it becomes really problematic because you have to remember that there are things what we call carry trades, where large institutions in Asia might be borrowing money at super low interest rates, and say in Japan you're borrowing at zero effectively, and then they come over and they buy dollar-denominated assets. So they're shorting their own currency, and then they're going long. We call it buying dollar-based assets, and that could be treasuries, even a 10-year bond at say 2.2%. So now you have an arbitrage situation where you're borrowing at zero, earning 2.2, and you're in dollars, which have been going up. And that's been the huge sort of trade, what we call a carry trade, that's been put on the books since last October. That's really concerning to a lot of people. That trade has swelled in size to almost $70 trillion in notional value. I know that doesn't make a whole lot of sense maybe to people listening, but just trust me, this is a significant situation, and so you want to monitor that. You don't want that trade to unwind in a chaotic environment. Then you go to Europe really quick. In Europe, certainly with Mario Draghi, who's the European Central Bank chairman, he's gone on his own QE program, $1 trillion a year in printing of euros. He's using the money to go in and systematically buy fixed income securities to try to prop up their credit markets and stimulate their economy. Germany is probably going to do well. France is somewhat doing better, although their domestic policies have been atrocious.
Tough, yeah.
You know. And then you go to the Middle East, where there's unbelievable instability, particularly with ISIS and terrorism. And then, oh, by the way, let's sprinkle in the idea that Vladimir Putin may decide to invade Ukraine. So
that's right.
There are a lot of issues going on around the world that you really have to pay very, very close attention to. And I think at any moment in time, any one of these events or scenarios, if they were to get any worse, could derail or significantly impact the U.S. economy in a negative way. So we want to encourage our listeners and our viewers to think about their investment portfolio and their retirement plan from a global perspective and not get lulled into this idea that, hey, I live in America, everything's going to be okay. You really have to monitor what's going on everywhere else, because things can unwind rather quickly.
Well, and look at all the American companies that are owned by foreign companies.
Right, right.
I mean, it's just amazing.
Yeah, exactly. And so even companies like McDonald's and Coca-Cola and all these great companies out there, the vast majority of their revenues and their profits come from overseas.
Absolutely.
And when the dollar's on a tear and going through the roof, that hurts them really badly. And certainly, you know, U.S. manufacturers, industrial manufacturers, and supply companies, et cetera, these companies whose end markets are overseas have also really been dealing with a lot of problems and trying to hedge away currency risk, which is not a cheap thing to do. So, again, you've got to think globally.
Right.
And that's one of the things we try to incorporate into our research every day when we start to deploy our clients' capital.
Okay, thanks for coming, and we're going to have you back many more times, because as the year progresses, we want to keep abreast of what's going on.
Absolutely.
And we'll be right back right after this.